Hi, and welcome to this session on how branding builds value and drives growth. Part of Quantum's FAST30 series, where we explore how to quantify and grow the value of intangible assets. And we're delighted to co-host this session with Principles Brand Consultancy, represented by the splendid Charlie Rose. Feel free to ask questions through the Q&A or chat buttons as we go along, but we'll come back to these at the end of the session. We won't dwell too long on intros, but Charlie is the Strategy Director of Principles and was voted Brand Strategist of 2024 in ANZ. Playing the role of the Thorn, I've been valuing brands for decades, and I'm the Managing Principal at Quantum. It's important to stress that we're not here to give adjacent perspectives of brand strategy and brand value. We're joining the dots, showing how brand strategy and marketing execution create added value when informed and tracked by value-based measures. Our focus is on growing business value through effective brand management. Over to you, Charlie.
Thank you, Tim, and thank you for your time this afternoon, everyone. Firstly, let's bust some myths, hey? Having worked with clients from across sectors and roles, when non-marketing people, and I know there's a number of non-marketing people in the webinar today, when they think brand, you default to logos, colors, tagline, advertising. But what sort of the missing piece of the puzzle is that it can be a lever for driving future demand, for driving operational efficiencies, for driving protecting margin, to expand into new products or services or markets, and ultimately drive the value of your business. On the previous slide, we talked about how brand drives future demand, but the challenge is many organizations still struggle to measure that impact clearly. When clients talk about brand, it's often discussed through awareness, perception, sentiment, important metrics, but not always directly linked to growth. That's where quantifying brand value becomes powerful. It's sort of shifting brand from a just marketing conversation to more of a strategic asset conversation. Because when you quantify brand value, you better understand what's driving customer preference, where your pricing power sort of comes from, and where future demand might be at risk, and sort of help shift beyond short-term metrics towards longer term, like margin resilience, long-term demand, and sort of customer loyalty. So once you start treating brand as a measurable brand asset, it has multiple uses. Obviously for marketing teams, it can improve decision making, where to invest, what's driving preference. For executive teams and boards, it connects branding to growth, to risk, competitive advantage, overall enterprise value. For partners, whether they be joint venture partners or sort of licensing partners, it's building confidence and strengthening your company's negotiating position. It's also increasingly relevant for regulators, tax compliance, when you need to report on intangible assets. And for most big companies, your brand is one of your most valuable intangible assets. And in fundraising and M&A, strong brands help tell a clearer story for growth and supporting valuation discussions. So how do we do this? How do we build value for a company using your brand? And most businesses start with a fairly simple question. When customers have a choice, do they remember you and do they choose you? Ultimately, your brand is here to make your company be remembered and recalled more easily, whether that's in-store, online, or in conversation. Brands and businesses succeed in being remembered in these buying situations. I need a tool, I go to Bunnings. That moment right there, that's the moment of truth. A strong brand boosts awareness and increases your chances of being chosen when somebody is ready to buy, even if you're a B2B company or a tech company and you don't have this bricks and mortar advantage that these retail warehouses do. When customers can recognize you in a split second, you reduce customer acquisition costs and increase preference over your competitors. Obviously, branding sort of drives price. When people feel positively towards your brand. They're willing to pay more, even when cheaper options exist. We all know that Apple is never the cheapest phone on the market, and it never will. But every year they launch a new iPhone, and every year people line up around the block to pay more. It's not just the product, even though it is a killer product, it's also the brand. So when customers trust a brand, they stop comparing price first. This reduces price sensitivity when things get rocky, and over a 5-year period, you can get this annual price lift, which that compounding effect, increases things dramatically. I hate to kick the bird in on Myer, but here we are. In contrast, Myer's brand has been in decline for a number of years, and not just Myer, but many retailers heavily rely on promotions and clearance cycles, Black Friday, for example, to drive traffic. Customers, then become trained to wait for sales. I'm not sure if you shop at Kitchen Warehouse, but they're always on sale, and margin becomes fragile. When consumers don't feel strong preference, they default to price comparison. And when costs rise, there's no room to move, and you get squeezed, and every downturn hurts more. Mecca is an incredible Australian homegrown brand, and down here in Melbourne, this new Mecca flagship opening was quite incredible. Got a lot of press. Had people queued down Burke Street Mall, but they cared because they care about the brand, its experience, and its products. Mecca customers don't wait for sales. Mecca is a great example of a brand with repeat purchase frequency, bigger basket sizes of customers, which results in customer lifetime value and overall revenue predictability. When Disney launches something new, it doesn't start from zero. It starts from a place of trust. Disney has expanded into kind of, more things than you think. Theme parks, cruise lines, merchandise, streaming across global markets. And each time they weren't introducing an unknown company, they were extending a familiar brand. This reduces friction because customers already believe in that quality and experience of the Disney magic. That reduces launch risk. It reduces customer acquisition costs and sort of time to scale and sort of take advantage of that market opportunity. And this can sort of compound and build into incredible valuations for businesses. In 2021, Afterpay was acquired by Block for approximately $39 billion. As we know, Block is sort of restructuring things recently, but that transaction and valuation wasn't just about the volume of transactions that Afterpay enjoys. It's because Afterpay has become synonymous with the category buy now, pay later. It's built a deep relationship, and affinity with younger consumers, and the brand reduced perceived risk of that valuation and ultimate purchase, and it justified that premium multiple. Over to you, Tim.
Sure. Well, let's explore how brand valuation can inform strategy. The first point is that brands are assets. Now, the image of the iceberg is there because, unfortunately, financial reporting results in only a fraction of brand value appearing on balance sheets. And this can kind of result in lack of awareness of brand value. But here are some transaction-based examples of brands appearing on balance sheets after a business acquisition. If you click on Charlie, so these aren't just values that appear from nowhere. They've been audited, they appear on balance sheets, and they're big numbers. But more so than that, for the consumer goods companies, the brand value represents a significant portion, perhaps 25 to 40%, depending on the circumstances, of the overall business value. And even B2B brands like Alstom can have very high values, although these will typically be a smaller proportion of business value. Another perspective of the economic potential or economic contribution of brands is licensing. All of these examples represent brand extensions where strong brands in one category generate new earning streams by licensing the brand IP to specialists in new product categories. And in these cases, the brand owner earns between 5 and 10% of each dollar of revenue that the licensee creates. This brand economics can be easily explained by blind tasting tests. So there are many examples, but here's one that's easy to get your head around or your taste buds around. If one has a blind tasting test, in this instance for Diet Pepsi and Diet Coke, Diet Pepsi had about half of the preference. However, with a different sample set, when they knew which brand they were tasting, if you click on, you'll see that Diet Coke dominated preference. So it's pretty easy to work out how that change in consumer perceptions impacts buying behavior and how buying behavior impacts earnings. If you click on Charlie, we've got a little diagram there just showing the activity influences the attitudes, the behavior, and the cash flows. But really important is the intellectual property, particularly trademarks, copyright, design rights, that protect the brand identity and distinctiveness and result in long-term cash flows. If we go on to the next slide, that shows how we can integrate this concept of brand economics into brand management. So the first step is what we call a brand grading. It benchmarks measures of brand equity, market performance, and protection against competing brands. The next step maps the impact of changes in brand equity on the value drivers depicted in that box: acquisition, retention, price premium, etc. The third step then is the development of a financial model that's informed by these insights. At the simplest, these are static models which attribute portion of future earnings to a brand and enable the valuer to quantify the brand value. But it's far more useful to develop scenario valuations which estimate the financial impact of different corporate actions on brand equity and value. If you click on Charlie, this shows a real life example, the final slide almost of this engagement showed the output of different strategies. So scenario A actually represented what the brand portfolio owner thought was a cunning plan to increase the margin of one of its brands. However, it turned out that this would actually destroy value relative to the base case, which depicted business as usual. Now, fortunately, in this instance, the analysis was carried out before scenario A was implemented, but also all of the analysis at a segmented level enabled the client to come up with a better scenario, which was scenario B, which not only did the financial modeling support as being the best strategy within a year of its deployment, and obviously accompanied by skillful marketing, scenario B was a proven success. If we move to another example now, just perhaps click through all of the build on this, Charlie. It relates to a retail brand which was strong in its core regional market, but greedy for growth in more attractive regions. And this growth was initially funded by a Robin Hood strategy, where budget was taken from the home market and allocated to the new markets. Fortunately, a kind of ongoing brand tracking study delved into the brand equity, and the picture in the middle shows how these different dimensions of consumer perceptions were tracked, and the orange line showed how there was slight erosion of brand equity in the home market due to its reduced share of voice. Again, the early identification of this problem showed that despite the added value in the growth markets, more value was going to be lost in the core region due to the erosion of brand equity. With that integrated valuation model, it was easy to demonstrate that risk to the client, but it was also then possible for them to develop the business case to invest in these new attractive regions whilst maintaining brand equity in the core market. And that revised investment captured the growth in the new markets and protected value in the core market. And back to you.
Thank you, Tim. So here's a sort of a simple brand growth playbook that we'll be sort of covering in over, for the next 15 minutes. Step one, as Tim has sort of clearly articulated, understanding your brand equity is sort of a key to growth, knowing what customers already value about your business and where your brand strength lies. Step two, unlocking sort of brand and market positioning and proposition, clarity on who you are, who you serve, and why customers sort of choose you over the competitors. Number three, oft forgotten, optimizing your portfolio as businesses grow. Simplify the complexity so it's easier to scale. And lastly, articulating value for stakeholders. Build confidence with customers, employees, investors, and partners. So let's just start with step one, understanding brand equity with one of Australia's modern fashion success stories, Zimmermann, founded by sisters Nikki and Simone. They've built a brand with globally recognized position around luxury resort wear, distinctive prints, and now I should say up front, I don't have any Zimmermann sort of items. I'm probably not the target market, even though it does look great, but it's clearly a distinctive and recognizable brand, and customers are willing to pay a premium for it. It was acquired in 2023 by Advent Private Equity at a eye-watering sum of over $1 billion Australian dollars, one of the largest global acquisitions of an Aussie fashion brand. And Advent took that majority stake because they saw a globally desirable premium brand with room to scale. They saw under-leveraged brand equity, a strong positioning, untapped global retail, and sort of fantastic premium product, and sort of latent value that they could grow. And with that PE backing, it grew from $300 million revenue to 645. Advent didn't reinvent the brand. They scaled the equity and what was already working. They expanded the footprint by 33 stores in 1 year. Brand desirability drove demand. Advent fueled capability and reach, which enabled rapid but low friction market entry to deliver significant growth. So how can you be like Zimmermann? Well, start with awareness. Do people know you exist? And then you sort of seek to drive distinctiveness. Are you easy to recognize and remember, like that Bunnings example from a few minutes ago? Familiarity. Have people built trust through repeated exposure? Salience. Do you come to mind in those buying moments? And preference. When customers have a choice, do they choose you? Which then drives future demand, which is the end game here, which is making future revenue more predictable and durable. So step two, the power of positioning and proposition. It's all about consumer relevance, and Godfrey's Dick Smith and most recently Barbecues Galore are sort of infamous stories of how, the slow decline due to the decline of consumer relevance. These national retailers didn't fail overnight. They lost consumer relevance gradually. Consumer expectations changed, competitors modernized, categories evolved. The brands tried, but they didn't go far enough. In contrast, last June, L'Oreal acquired this British premium skincare brand Medik8 from private equity firm Inflection. This was not a product acquisition, it was also a brand acquisition. Inflection didn't simply scale distribution, they invested in packaging, distinctive assets, a consistent brand story, and a premium positioning. They position Medik8 very clearly, performance-led, clinically credible, globally relevant. That reduced category competition and protected margin. It was a smart, staged brand investment aligned to growth over many years. And L'Oreal could, it could see a clear place in a significant kind of overwhelming global portfolio as a clinical premium product. They saw strategic growth and sort of future multiples wrapped up there. Now, to shamelessly include a principals project like Tim did, we've been Officeworks brand partners for 6 years now, and we all know that Officeworks has been a category leader in stationery and office supplies, for decades. But growth, is increasingly elsewhere in furniture, education, art, services, and technology products. So Officeworks needs to change too. Not just the brand identity and the removal of the iconic pin, but also a multi-category consumer positioning, kind of going where the relevance is. The pin sort of was holding the brand back in stationery. It was a category coded symbol, a shorthand for office supplies. It said we sell paper and pens, but that sort of bold move sort of helped sort of shift into a new market positioning that was sort of less functional, more creative, human, and dynamic, especially in a post-pandemic world where work and life, have kind of unfortunately become one. It sort of helped them sort of move into these sort of growth categories. And in our latest national brand study, Officeworks has come out as one of Australia's top 5 most distinctive brands, which is a truly valuable, intangible asset. So, don't be afraid to make big, brave decisions to modernize your brand for consumer relevance and proposition. Portfolio optimization. It sounds academic. It's actually quite practical. As businesses grow, complexity grows with them. Products, more services, more brands. Over time, that complexity starts to gum up the gears and slow a business down. So let's bring this to life with an example. Moving away from premium products into B2B brand building, which I'm sure concerns many of you. IntelliHub is one of Australia's most successful companies that you've never heard of. It operates at the centre of Australian and New Zealand smart metering and the energy transition ecosystem, working with big energy companies and sort of tech providers. It's quite complex software and hardware solutions for businesses, for enterprises, and for homes. It started as a leading smart metering provider across New Zealand and Australia. Now operates, as you can see here, over 3 million smart meters, but it increasingly plays in solar, battery, EV, digital energy services, which, as you can imagine, is booming right now. Over time, through growth, acquisition, and expansion, complexity has built. Multiple products, sort of naturally get acquired or launched, and there's sort of new names or new brands, and new propositions, and they all have a role. They each have a clear capability, but over time it creates confusion. It sort of creates, customers aren't clear on what's connected to what. How does it all fit together? What am I buying here? What's the role of IntelliHub versus all these products? And a branded house for IntelliHub simplified everything. With the IntelliHub brand leading and collapsing all the product brands into an IntelliHub offering with sort of 4 market-facing sub-brands, we have a suite of products that can help our 4 different types of customers. We've got a clear story, strong recall, and faster understanding, which improves marketing, return on investment, media investment as well, and as well as internal alignment. Over to you, Tim.
Sure. Well, here's another example of using value-based marketing to inform brand architecture. And this is a large industrial group that had developed a dog's breakfast of brands, sub-brands, and product descriptors. The head of corporate affairs knew that portfolio rationing was needed, but needed financial support, both to develop optimal architecture, but also to get all of the stakeholders on board. And the top chart confirmed his suspicion. Many of the sub-brands had very little brand equity and value, despite some being associated with high revenue products. Our analysis also showed that although the corporate brand was reasonably strong, it was making a lower contribution to enterprise value than some of its peers. And the analysis showed that a more coherent brand architecture, greater focus on the corporate brand, would increase overall brand value and business value. So if we click on to the next one, this is getting back to the articulating value with different stakeholders. And it's harder often to get non-marketing stakeholders on board than it is to those marketing decision makers. But it's equally important. And we do a lot of work where the audience is the executives or the board, and making sure that they understand the current value, downside risks, and upside potential of all intangible assets, including brands. Additionally, it's increasingly common for investors to look at companies and realize there's not much on the balance sheet relative to what they perceive the intrinsic value of the business is, but to make smart decisions, they need to understand the quality and value of those assets. If we click on, you'll recognize the boxes in this slide, but this time they're used to demonstrate how a connected brand valuation provides a compelling commercial narrative. And that third box, the value, doesn't just stand in isolation. The value assumptions and findings flow from and are supported by the grading of the brand and other assets and the mapping of the value drivers. And if we click on in the transactional perspective, you'll see that that often results in higher multiples being achieved in fundraising, exits, or other M&A. So if we move on to the last slide, you'll see that we've gone through at a good gallop. This, as the title indicates, focuses on a transaction. So the backdrop to this is we had a mature listed company, but it had an underperforming and complicated brand portfolio that investors didn't understand very well. A takeover offer came, and the first chart shows that this was slightly above the market capitalization, but beneath what the board expected or thought the intrinsic value was. If you could click the build, Charlie. So the project was to come up quickly, because the clock was ticking in terms of the offer, with an assessment of the value of the business as a whole, but working out what assets were driving that value. So another chart on the top right of this shows, again, the piece of analysis that was carried out. And we discovered as we went through the market and the brand data that a key brand had been repositioned following some new product development, and this was starting to gain traction in the market. Similarly, distribution channels had been enhanced, but this hadn't been communicated well to the market. And analysts and investors just didn't understand the portfolio. So similarly, we had this connected analysis showing the strength of the different intangible assets and their impact on value drivers. And in this instance, the output was showing the full value, the intrinsic value of the business compared to the offer, but making sure that that didn't stand in isolation, showing the building blocks, the different assets that were contributing to that value. And in this instance, it wasn't just the brands, but also the contracts, customer relationships, and other intangibles that business held. And in that instance, the bid was massively revised by almost 50% before being accepted by the board. So once again, it's shining a light on the brand and the other intangibles and being able to communicate that in a defensive fashion to the stakeholders. So that's the end of our formal presentation. I hope Charlie and I have demonstrated that value-based brand strategy builds business value and drives growth. But we're certainly keen to take questions as they come through. Let me just have a quick click to see what's going on there. as far as I can see, we're pretty low on questions at this stage. So I'll throw one at you, Charlie.
Yes, Tim.
Is it a frequent frustration of your clients when you're dealing with a CMO rather than a broader sort of leadership group that they battle to articulate, kind of the impact of what they're doing to the broader stakeholders?
Yes, I hear it often. What I find is most helpful to bring brand valuation into the process is when you're trying to get a large scale investment in a brand program happening, and you need to get that sign off with some sort of brand skeptic, sort of whether it be other executives. And what I find is that articulating the value of what the brand brings to the business sort of helps the case for change and the case for investment, to sort of unlock the inertia. So yes, it does come up multiple times a year, Tim. No doubt about that.
Just another observation, but whilst we're chatting, feel free to post any other questions or comments. But something that I've often observed, you might be start a project either coming in through the marketing door or the strategy door or the finance door. Someone's got a particular need to value a brand. But as soon as you show the connections between the different silos of information and the different silos of decision makers, being able to show that brand equity isn't just some sort of tree hugging measure, but it does impact on behavior, it impacts on market performance, and showing that financial forecasts that are just sort of created in a vacuum by a finance department without integrating those insights of the market and the brand, that the connection kind of really adds value. The minute you start having those discussions, it's almost like you're a translator within a room where the stakeholders had previously spoken different languages, but suddenly they're kind of speaking a common language, or they're understanding the connections between those, and that can be really a fundamental change in an organization. Well, if we don't get more questions, we'll be able to give you back some time. But Charlie, I just wondered if you had any other, I think had both been focusing on galloping through at high speed so that we didn't tarnish the FAST30 concept. But if you have any other concepts or comments, please add them in.
Sorry, Tim. Two questions just came up at the Q&A.
Okay. Oh, yeah. Good. Yeah. Okay, so here we go. What are some differences in your price process now from a year or more ago? So from a brand valuation perspective, a lot stays the same over time, but obviously markets, the rate of change, and various other things are consumer expectations are moving rapidly. So, in some instances, there might be greater focus on different metrics, or there might be a need to have a better understanding in the connection between intangibles, brand and technology and data and so on. So one has to be responsive to the market, but at the same time, a lot of this kind of value-based framework stays the same. Charlie, did you want to comment on that?
I mean, the most obvious thing for me to sort of call out is the role of artificial intelligence in the sort of the working process of our clients and the way that they are taking their brands to market. I think it's not completely sort of automated or anything, but it is an important part of the workflow. We're having to help them sort of help bring their brands to market using AI tools, and the way that we help, we advise on strategy, we advise on research, we advise on design and copywriting, is to sort of help them sort of implement at scale because budgets, as Tim spoke about, sort of volatility and things like, but budgets do get tighter, and there's increasing pressure to sort of respond more in a more agile fashion, and sort of we're very much helping sort of create brands and sort of and propositions that can respond to those rapid changes.
The second question, Charlie, probably best if you have the first stab, and then I can add anything on. So it says what you take into account when considering a new brand strategy, that is assessing a master brand versus a house of brands, and how do you work out what will drive better long-term value?
Yeah, no, it's a great question, and what we're finding is that over the last decade, there's been a bigger shift towards a master brand approach due to the ubiquity of sort of digital devices, mobile devices, and how sort of, the world is at your fingertips now. Brands used to create these house of brand models as almost create these to sort of de-risk the company from, whether it be PR disasters or from and just to, puts things at arm's length from a reputational point of view. But what we're finding now, you can't do that anymore. And what the name of the game is delivering effortless, seamless customer experiences that are easy to access services, easy to access products, whether you're B2B, B2C with government, what have you. And you having a brand system that gets out of the way or facilitates easy customer sort of transactions and experiences is the name of the game. Having said that, obviously, if you have a suite of hotels, you wouldn't, you would very much explore a house of brands model. It's not a one size fits all, but that's sort of the general trend, sort of over a number of years now. So it is a case by case basis in terms of what will drive better long term value, but people do underappreciate the upfront and ongoing marketing investment it takes to water many plants from a branding point of view. And I would advise to sort of reflex towards a master branded approach initially, at least, and sort of see how far away you sort of move away from that position.
Okay, the questions are flowing in now, so I'll take this. There's a link, this one from Mahesh, where he asks if there's any research to tell how brands are positioned in the minds of board members in the C-suite across different sectors. Just anecdotally, I was presenting at a group of 50 non-executive directors a few years ago and did one of those polls asking them what information they got about the value of brands and other intangible assets and what key performance measures they got, even if it wasn't value. And it was a very, very low take up. And, actually you could almost see the furrowed brows when we said, well, yes, but the majority of your business values are made up of intangibles, and your duty of care towards intangibles is exactly the same as bricks and mortar. So Mahesh, don't have it across sectors, but I suppose anecdotally you have those traditionally brand-centric sort of FMCG type brands where there's businesses where there's much greater awareness than in others. Another one from Umesh, who asks about while licensing an established global brand may be quicker and easier, how would you rate establishing a new brand, being an uphill task? So I'll do the first bit and then pass to Charlie. I guess it's that risk management. If you've got a plug and play, you've got a proven brand, a strong brand, less marketing investment, you can plug it into a business model, and generate earnings immediately, although you will have to pay a royalty back to the owner. Charlie, you're better equipped to talk about the uphill task of developing a new brand.
Yeah, it certainly is an uphill task. I think that's well put. I was just on a call with, a nameless client earlier. They've been in market for 10 years, and their awareness remains at single digits, and they're $1 billion company. And, I think that sort of illustrates the uphill task it is to actually penetrate, people's minds and sort of be remembered. It is incredibly hard these days in a world of sort of congested social media feeds and competing in interest. I think Afterpay is an incredible example of having an incredible sort of disruptive product that sort of very quickly drives. I think my sort of advice on quickly establishing a brand would be through sort of brave calls and trying to be highly distinctive in the sort of the positioning and the sort of the brand choices you make, whilst not completely eroding at credibility. You're not going to get anywhere by completely embracing category conventions.
We've got time for two more. One is an easy one. Dustin, we'll be sharing the slides after the session, and you'll also all be sent a link to a recording of the video if you enjoyed it so much that you'd like a resit. Another slightly longer question relates to assessing the value of intangible assets in setting an acquisition price, and asking when that should be done or which instances it should be done. I guess the important thing to make in any transaction for any business, unless as a seller you can identify the assets that are driving your business value and communicate that effectively to the potential investor or buyer, it's unlikely that you'll be able to extract the full value of those assets. So I say for any type of business, brand might not be the dominant asset. Maybe it's technology or data or customer assets, but identifying that full suite of assets and being able to articulate that quality and value is a good move. Similarly, for an investor or a buyer, unless you know what assets are driving the kind of anticipated earnings of the business, you're kind of shooting in the dark, really. You need to understand the value. You wouldn't just buy a property company and say, oh, they've got some property somewhere. You'd want to know what it was, where it is, size, quality, all of that sort of stuff. And the same thing applies to intangible assets. So we would always say, a deep understanding of the asset base of a company is kind of absolutely essential to make smart investment decisions. And hopefully, as we've said, for a company that you already own, making smart decisions about increasing the value of your brand portfolio.
Well said, Tim. Thank you.
Great. So that probably gets us to the end of the session. So thank you very much for joining. I hope you found it useful. Thanks very much to Charlie and Principles, and we'll follow up with the link and the slides. Thanks a lot. Cheers.
Thank you, everyone.